Is the banking crisis back? Last week, First Republic Bank revealed that it had lost over 40% of its deposits in Q1, sending its stock tumbling and likely causing more deposit flight. Over the weekend, First Republic Bank was seized by US regulators and sold to JP Morgan, making it the third US bank to go down in less than 2 months. The trillions of dollars of unrealized losses and slow trickle of deposits into high-yield assets has led to speculation that it's only a matter of time before more banks go under. That's why today I'm going to explain why so many banks are failing, examine why First Republic went bankrupt, reveal whether the banking crisis really has returned, and tell you what it could all mean. Let's start with a quick recap of the banking crisis. If you watched our video about Silicon Valley Bank, or SVB, you'll recall that it was seized by regulators on Friday, the 10th of March. This happened because the bank saw $42 billion of withdrawals the day before, and regulators knew it couldn't honor any more. You'll also recall that the actual cause of SVB's collapse was a massive mismatch between its assets and its liabilities, in this case, its customer deposits. In case you didn't know, the money in your bank account technically isn't there. It's all been lent out or invested by your bank so that it can make money. Believe it or not, but the bank is only obligated to keep a small percentage of your money on hand in case you need to withdraw it. This is called fractional reserve banking, and it works so long as everyone doesn't rush to withdraw their money at the same time. Obviously, this involves a lot of trust. If you think about it, the only reason why people rush to withdraw their money from a bank is because they don't trust that the bank can honor withdrawals for whatever reason. As such, you could argue that the banking crisis we're seeing is not so much a crisis related to economics, but a crisis related to trust. Even so, economics does play an important role, and this is certainly the case with the current banking crisis. As I mentioned in the introduction, US banks have roughly $1.7 trillion of unrealized losses on their balance sheets. Logically, this has led to concerns about their ability to meet withdrawals. The reason why banks have such large unrealized losses is because the Fed has been raising interest rates. Banks are required to invest customer deposits in safe assets such as US government debt, aka US bonds. Ironically, US bonds saw their worst year in centuries in 2022 due to the Fed's rate hikes. Again, this is fine so long as not everyone rushes to withdraw their money at the same time. That's because everyone rushing to withdraw means that banks are forced to sell their assets to honor those withdrawals. This would turn unrealized losses into realized losses and potentially bankrupt the bank. If you watched our video about the US banks that are at risk of going under, you'll recall that unrealized losses are only half of the risk equation. The other half is how many uninsured deposits a bank has. In other words, how many of their customers have account balances larger than the insured limit of $250,000. Case in point, SVB had the largest number of uninsured deposits as a percentage of its total deposits, besides the megabanks. Signature Bank was in second place and was also seized by regulators on the weekend of the 10th of March. Can you guess which bank was in third place? That's right, First Republic. For those unfamiliar, First Republic is, or rather was, a regional bank based in San Francisco, California. Like SVB, First Republic catered to high net worth clients across the United States. Most of this catering came in the form of mortgage loans, which made up almost 80% of its more than $200 billion in assets in 2022. Not surprisingly, fears over First Republic began immediately after SVB went down. This is simply because investors could see that First Republic had a similar risk profile to its peers. In its Q1's earnings report, the bank specified that customers started withdrawing their cash on that same Friday, the 10th of March. On Sunday, the 12th of March, First Republic announced that the Fed, the Federal Home Loan Bank, and JP Morgan had collectively pledged to provide it with $70 billion of liquidity to keep it afloat. The announcement also noted that the bank had access to the Fed's new BTFP facility. For context, the Bank Term Funding Program, or BTFP, was set up by the Fed that same Sunday, the 12th of March. The BTFP makes it possible for US banks to borrow against their assets as if there were no unrealized losses. This is because assets like US bonds mature at their full value. Topic for another time. Now, although First Republic's announcement quelled fears that the bank would go down, it didn't take long for everyone to realize that the bank couldn't tap the Fed's BTFP facility to the same extent as the other banks. This is because most of its assets were regular mortgages, which couldn't be used as collateral. It appears that withdrawals continued until Thursday, the 16th of March, when Wall Street's biggest banks deposited $30 billion into First Republic. The bank's Q1 earnings specified that, quote, at that time, daily deposit outflows had slowed considerably, suggesting that this managed to stop the deposit flight. While First Republic's Q1 earnings claimed that everything was fine after that, the headlines suggested otherwise. On the 26th of March, Bloomberg reported that the Fed was working with regulators to expand the BTFP facility so that banks, namely First Republic, could use other kinds of assets as collateral for loans. This would have been an unprecedented move because it would have been definitive proof that regulators were bending the rules to protect the assets of the rich and powerful. Fortunately, or unfortunately, the BTFP was never expanded, but the fact that it was even discussed is bad enough. In any case, on Monday, the 24th of April, First Republic published its Q1 earnings report. This revealed that its total deposits had fallen by 41% to $104 billion, a figure that included the $30 billion liquidity injection. This came as a shock to investors, who were expecting the bank's total deposits to be closer to $145 billion. For reference, investors don't mind bad news so long as it's roughly within expectations. This is why the huge discrepancy between expected and actual deposits caused First Republic's stock to implode. This, in turn, resurrected the speculation that the bank would soon face the same fate as SVB and Signature. First Republic wasn't going down without a fight, however. On Tuesday, the 25th of April, Bloomberg reported that the bank was considering selling $50 to $100 billion of its assets, which you'll recall are primarily mortgages. The unnamed source also said that the bank was planning on raising additional capital. On Wednesday, the 26th of April, CNBC reported that First Republic was essentially threatening big banks to bail it out, or else. Quote, purchase bonds from First Republic at above market rates for a total loss of a few $1 billion, or face roughly $30 billion in Federal Deposit Insurance Corp fees when First Republic fails. At the same time, BTC began to rally on the belief that the Fed would be forced to expand its balance sheet to bail out First Republic depositors the way that it did with SVB and Signature. The fact that this kind of bailout didn't occur could actually be why BTC crashed earlier this week. More on that later. Now, on Thursday, the 27th of April, Bloomberg reported that the situation had escalated to, quote, a game of chicken between the US government and the lender's largest rivals. Put simply, US regulators were waiting on the sidelines to see if First Republic could convince the megabanks to give it money again. On Friday, the 28th of April, the regulators had gotten tired of waiting and, according to Reuters, began holding, quote, urgent talks with First Republic and its former saviors. By this point, it had become clear that the bank was going to be seized by US regulators, and its stock somehow managed to crash even more. Now, I'm not sure who needs to hear it, but just because something is down 90% doesn't mean it can't go down another 90%. Regardless, on Saturday, the 29th of April, Fox News reported that First Republic would be seized by the FDIC. On Sunday, the 30th of April, the seizure was confirmed and First Republic was subsequently sold to JP Morgan. Being sold to JP Morgan meant that there was no need for a Fed bailout, as had been the case with SVB and Signature. On that note, if you watched our video about the hearings following the banking crisis, You might recall that the FDIC had actually received offers from 2 regional banks to buy SVB on the weekend it went down. The FDIC refused these deals for unspecified reasons, which is interesting to say the least. This relates to the terms of the First Republic sale, which are equally interesting. The FDIC claims that there was a, quote, competitive bidding process for First Republic over the weekend. JP Morgan won and acquired $173 billion of First Republic's loans and $30 billion of its securities. JP Morgan also assumed all of First Republic's deposits, which had fallen to $92 billion prior to its collapse. This figure again includes the $30 billion that JP Morgan and other Wall Street banks had injected. According to CNBC, quote, large deposits will be repaid or eliminated in consolidation. Finally, the FDIC will share any losses on First Republic's underwater loans with JP Morgan. According to the BBC, the FDIC Insurance Fund will lose about $13 billion in this deal. That amounts to almost 10% of the money in the fund, which is meant to backstop all insured deposits in the United States. To put things into perspective, the FDIC's insurance fund would only be enough to cover around 1.3% of all insured deposits in the United States in the event of a full-scale banking crisis. The catch is that this isn't the only money the government can use to bail out the banks. They could use your money too. More about bank bail-ins using the link in the description. Now, this begs the question of whether we are about to see a full-scale banking crisis or whether the collapse of First Republic has marked the end of this madness. The answer ultimately depends on whether there are any other banks which have similar risk profiles to SVB, Signature, and First Republic. As I hinted earlier, many of the megabanks have comparable levels of unrealized losses and uninsured deposits as a percentage of their assets and liabilities. The thing is that these banks are considered systemically important, meaning they're basically backed by the Fed and are very unlikely to fail. This is why deposits from small and medium-sized banks have continued to migrate to these big banks. Now, in theory, small and medium-sized banks could follow in the footsteps of First Republic if these outflows continue and they break under their unrealized losses, primarily on commercial real estate loans. In practice, however, outflows from most small and medium-sized banks seem to have slowed significantly, and, for many, their deposits have started increasing again. This could mean that First Republic was the last bank to fail. If there were any others, we'd have heard about them by now. This is a fascinating possibility because everyone was expecting that small and medium-sized banks would start failing one by one as deposits were withdrawn and unrealized losses took them down. This narrative was being pushed by all kinds of media, and I must admit that I participated in the pushing. In my defense, the narrative makes a lot of sense, especially when you consider the possibility that the Fed wants to consolidate the banking sector in preparation for a central bank digital currency, or CBDC. It also makes sense when you consider that all the shares in the Fed are owned by the megabanks. Now, consider this. In the next few days, all of First Republic's bank branches will have been rebranded to JP Morgan. Call me crazy, but I think this is an outcome that megabanks would love to see for every small and medium-sized bank in the United States, and it's one they would encourage if they could. This means the better question to ask might be why we're not seeing the banking crisis that should be occurring given the circumstances. Interest rates on deposits are low, unrealized losses are high, and there are lots of uninsured deposits. By all accounts, there should be more deposit outflows. The answer seems to be something that's been completely ignored, and that's the relationship that small and medium-sized banks have with their depositors. This relationship makes it easier for depositors to trust that their banks won't go under, despite the circumstances. Remember what I said, trust is key. More importantly, depositors at small and medium-sized banks are probably aware that they won't ever get the same service from the big banks. You will never see big banks offering extensive services to so-called high-risk clients which work in industries that go against whatever political agenda is in play. If you watched our video about Signature Bank, you'll know that servicing these underbanked clients is the bread and butter of small and medium-sized banks. They often have a vested interest in making sure their clients succeed. The result is that their clients will never leave. Besides, where else could they really go? This is why I don't think it's a coincidence that Apple announced its high-yield savings account with Wells Fargo soon after it was discovered that deposits from small and medium-sized banks were stickier than expected. I believe the big banks are trying their best to unstick these deposits. I don't think it'll work. This brings me to the big question, and that's what this banking crisis, or a lack thereof, could mean for the markets. If the banking crisis continues, recent events have shown us that there are two possible outcomes. The first is a de facto bailout by the Fed, and the second is an acquisition by a megabank. As we've seen, a de facto Fed bailout results in a market rally. This makes sense considering that the money on the Fed's balance sheet tends to find its way into the market. In the case of SVB and Signature, the money was used to honor withdrawals, and many of these withdrawals probably found their way into US bonds. As we've also seen, an acquisition by a megabank again results in a market rally. This makes sense considering that an acquisition sends a better signal than a bailout. It seems that the only sector which suffers from this is crypto, which, as I mentioned earlier, was itching for some more Fed liquidity. If this banking crisis continues, we could also see the FDIC increase the insurance threshold on deposits or even remove this threshold entirely. This would effectively mean the Fed is guaranteeing all bank deposits, which is not far off from a CBDC-type arrangement. Let's hope it doesn't come to that. Now, if the banking crisis doesn't continue, then this could actually be bad news for markets, and that's for two reasons. First, the absence of a crisis means that the market is unlikely to get the Fed pivot it's been itching for. And of course, no Fed pivot means tighter financial and economic conditions. This ties into the second reason, and that's credit. Even though small and medium-sized banks have managed to weather the recent storm, they have been spooked. Consequently, they're starting to be more careful with how they manage their balance sheets, and that includes who they issue loans to. According to the Fed's own statistics, credit availability fell off a cliff at the end of March. Banks reduced their lending activity by more than $100 billion. If you look closely, you can hopefully see that this has only happened twice in recent history, before the dot-com crash in 2001 and before the 2008 financial crisis. Newsflash, but the constant creation of money is required for the fiat Ponzi scheme to work. If this credit contraction continues, the US economy will follow suit, and this will eventually be reflected in the markets. Note that this is exactly what the Fed wants because it will bring inflation down. The practical effect of this credit contraction will be a recession, which many analysts, myself included, have been calling for since last summer. So far, no recession, but these things do take time. Interest rate hikes can take over a year to affect the economy. The credit crunch also takes months, and it's only just begun. Based on what I've heard on the many macro podcasts I listen to, a recession could start as soon as this summer or as late as next spring. Some macro analysts also believe the recession won't happen for technical reasons. For example, unemployment could remain low in stark contrast to real recessions. Now, I can't say I know which way it'll go, but I reckon that markets will struggle even without a recession if this credit contraction continues. For the time being, it looks like it will, but this doesn't mean the Fed won't be injecting liquidity elsewhere for other reasons. If it does, well, get ready for a market rally. And that is all for today's video. If you found it informative, be sure to smash that like button to let me know. And remember to subscribe to the channel and ping that notification bell before you go. Also consider sharing this video so that your friends and family know what to expect if the banks do blow. If you happen to be into crypto, I've got thousands of dollars of discounts and trading incentives thanks to my exclusive codes. If you want to get those, head on down to the description and check out the Coin Bureau deals page pronto. As always, thank you all for watching, and I'll see you next time, yo.